Hello, everyone. Chapter 3, Working with Financial Statements. Um, I'm going to go over the cash flow statement, which is the third financial statement that we will go over this semester. The first one we went over was the balance sheet. The second one was the income statement. And now we're going over the cash flow statement. Cash flow statement is a very simple statement. Like it says, it's a cash flow. It shows you the movement of your cash throughout the cycle of your business. All right. And this cash flow statement, the statement has three main sections. Three main sections. Okay. Section one is your cash flow from operation. Okay. Cash flow from operation is simply the cash flow that you receive during the normal course of your business. Okay. This is the cash flow that you receive during the normal course of your business. So I'll say cash. This sign is for cash. Cash flow received during the normal course of your business. Okay, so this is as simple as that. The second section or category is the cash flow from investing. Okay, cash flow from investment. It's usually the cash outflow or the investment made into either building a new building, either buying a new piece of equipment, or buying land. Right, it's property and equipment. So that's all it is. So it is the investment in a fixed asset. Okay, and in the third section is your cash flow from financing activities. Okay, cash flow from financing. We'll go in more detail about these three sections in the next slide. Cash flow from financing. So basically, this is the movement of your cash from financing activities, meaning that either you borrowed some money or you made a payment on the debt that you owed. So we'll say here this is debt, right? And in both long term and short term. Okay, so let's go over each of these sections and give you guys a little information about each of these sections so you can understand. First one, we said that was a cash flow from operation. I'll abbreviate that into CFO, cash flow from operation. Okay, CFO. We said this is the cash that you receive for during the normal course of your business. So how does it look? What makes the cash go up or go down? So if we're talking about normal course of business, right? So your cash should increase. This is money. Your cash should increase when you get paid from a customer. Okay, so you sold a piece of equipment, you sold a widget, and then you get paid from this customer. Mr. John owes you money. Mr. John pays you. All right, so your cash will increase because you receive some money. Right, you receive some money from John. All right, and your asset, your cash on your balance sheet will increase. Well, if you look on your cash flow statement under the cash flow from operation, you should see an increase in your cash because you just got paid from Mr. John. What will make your cash decrease under this category? Your cash will decrease under this category if you, as a business owner, pay your IOUs, right? If you pay your IOUs, then there'll be a decrease in your cash. And what might be those IOUs during the normal course of your business? It could be an accounts payable, it could be you purchasing inventory, it could be any expense that is done for this business. All right. So your cash from operation, what makes the cash go up? If you get paid from a customer, what will make your cash or might make your cash go down? If you've paid your accounts payable, you've purchased inventory of your, or you've done some expenses that are expenses that is in line with your normal course of business. All right. Next section. Next section, the next category is your cash flow. Whoops, I'm sorry. Okay. Next section is your cash flow from investing. What may make your cash go up or down in this category? One second. Okay. So your cash flow from investing or from investments. Okay, and we say this is investment in fixed asset. We'll write in bracket here, fixed asset. So what may make the cash increase or decrease under this section? I don't know why I can't delete that. Whatever. Okay, so your cash will we'll decrease first. Your cash will decrease under this category if fixed asset, right? If you build a new building. So if you invest 500,000 in this new building, well, your cash will decrease the amount of fixed asset. Your cash will decrease under this category, and your fixed asset on your balance sheet will increase by the same value of this building or this new piece of equipment. So we'll say that you've built or you're building this new building, therefore you got to spend the cash to build this new building, and your asset will increase by the same amount of money this building will cost you. So let's say this building is $500,000. You will spend $500,000 here to buy this building or to build this building, and then on your balance sheet your assets will increase by $500,000 because now you have a fixed asset that is worth $500,000 on your balance sheet. On your cash flow from investment, you will show a decrease on your cash, right? That's why we say that your cash decreases under the cash flow from investment. It decreases by the same amount of money that you spent to build this new building. Then your cash will increase, right? Then your cash will increase if 5 years later you decide to sell this building. So if you sell this building, your cash will increase by the same amount of money that you were able to sell the building for. You might not sell it for $500,000. Maybe the building is worth more, or maybe the building is worth less. Whatever amount of money you sell this building for, your cash will increase by the same amount of money. Okay. What else could be found under cash flow from investment? Well, if you decide to buy stocks into another company, right? If you decide to buy stocks into another company, well, your cash will decrease because you made a purchase, right? You bought stocks. We'll say buy here. If you bought stocks, well, your cash will decrease. And then whenever you sell these stocks, your cash will increase. As simple as that. So remember, the cash flow statement shows you the movement of the cash within the life cycle of your company. If you decide to purchase stocks in Apple, right? If you decide to purchase stock, this is the symbol for Apple. Not symbol, but the code for Apple. If you decide to purchase stocks into Apple, when you buy the stocks, right? You purchase the stocks, your cash will go down by the amount of money you spent on these stocks. Well, when you sell the stocks, your cash will go up by the same amount of money that you were able to sell the stocks for. Okay, simple as that. Cash flow from investment, mostly it is in fixed asset. Also, if you decide to buy stock into another company, well, there is a movement in your cash flow as well. It goes down when you buy the stocks. It goes up when you sell the stocks. Same thing for a fixed asset. If you decide to build a new building or buy a piece of equipment, well, when you build it, your cash will go down. When you sell it, your cash will go up. As simple as that. Okay. Now we'll go over the third category or the third section, which is cash flow from financing. And we'll see exactly how the cash moves within this section. Give me a moment here. Okay, third section, we said it was cash flow from financing. Okay, now when you hear financing, what are you thinking about? When I hear financing, I'm thinking about debt, long-term, and short-term. Okay, debt, long-term, and short-term. So how does my cash behave under this category? Well, if I need to borrow money, if I need to borrow money from the bank, if I need to borrow money from shareholders or wherever I'm getting the source of money from, well, it is going to be under cash flow from financing. So your cash will increase if you've obtained a loan from the bank, right? Let me draw this again. It's a bad design. Okay, we'll do it again. If you decide to borrow some money from the bank, well, that's a bank. If you decide to borrow money from the bank, then the amount of the money that the bank lends you, your cash will increase by the same amount, right? So you borrow money, right? Let's say you borrow $1 million to start a business or to expand your business, right? You get an inflow of $1 million into your cash. So your cash increases when you borrow money from the bank. Now your cash decreases, right? Your cash goes down every time you make a payment on that note, whether you paid in full, right? Whether you pay that $1 million back in full, or you make interest and principal payment on that loan, well, your cash decreases every time you make a payment. All right. So here we'll say payment. Okay. Whoop, sorry. I don't know what happened, but we'll do it again. Okay. Third category is the cash flow from financing. Sorry. Cash flow. Having some technical difficulties. Cash flow from financing activities. All right. And we said your cash will increase if you borrow money from the bank, right? Let's say you want to borrow $1 million to start a business or to expand. This is your bank. All right. So the inflow of $1 million will increase your cash by $1 million. And once you start making payments, we'll call this payment. Once you start making payments on this loan, then your cash will go down by the same amount. So you start paying the loan, whether it's principal and interest, plus interest, right? These are your debt payments, short term, principal and interest, that's short term, or you pay off the loan. This is your long term, right? So every time you make a payment, your cash will decrease. Every time you have an inflow, you borrow money from your bank, the cash will increase. Okay, as easy as that. Let me summarize your cash flow statement. It's a very important statement. It shows you the flow of the cash, right, during the cycle of a business. And it has three categories. It has the cash flow from operation, which is the money you receive or spend from normal course of business. Your cash will go up if you get paid from your customers. It'll go down when you pay back your suppliers, right? Accounts payable, inventory, or any expense during the normal course of the business. Second section is your cash flow from investing activities. This is investment either in fixed asset or if you decide to purchase stock into another company. The cash will decrease if you build the new building or if you buy the stock. The cash will increase when you decide to sell that building or if you decide to sell the shares that you purchase into that company. The third section is your cash flow from financing. The cash flow from financing here, the cash will increase if you borrow money from the bank, right? There's an inflow in cash, and the cash will decrease if once you make payment on the debt, short term and long term, right? Your short term will be your principal and interest payment, and your long term is if you pay off the debt. All right. So that's it about cash flow statement. It's fairly easy to understand. It's fairly simple, and that's that. Thank you very much.